Maya never took out a loan, never missed a credit card payment, never made a single financial decision she thought was reckless. She was careful. She was responsible. She tracked her spending. And on the 15th of the month, 10 days before her rent was due, her account had $23 in it. She had no idea why. She had not bought anything extravagant. She had not been irresponsible. She had just clicked pay in for, over and over again, across 6 different apps, across 12 different purchases, across 8 months. And by the time she sat down to figure out what had happened, her money was already gone. This video is going to show you exactly how that happens, and exactly what to do about it. Before we go further, Maya is a fictional character. Her story is not the account of one specific real person, but every detail of her situation, the number of apps, the total balance, the way the debt accumulated invisibly, is drawn directly from real data and real patterns that affect tens of millions of people right now. Maya is fictional. The trap she fell into is not. Let me show you exactly how it works. Maya was 28. She worked in marketing. She earned $52,000 a year, enough to cover her rent, her bills, and have something left over each month. She discovered buy now, pay later the way most people do. She was buying a pair of boots online, $180. And at checkout, there was an option she had not seen before. For payments of $45. No interest, no credit check, no forms to fill in. Felt like the smarter choice. She said yes. Over the next 8 months, Maya used it 14 more times. A laptop stand, a skincare set, clothes for a work trip, a birthday gift she could not quite afford that month. Each purchase felt considered. Each payment felt manageable. Each decision, taken individually, seemed completely reasonable. But nobody, not the apps, not the checkout screens, not any of the marketing, ever showed her the total. 6 apps, 14 purchases, payments going out on different dates throughout every month. Some weeks 2 payments, some weeks 3, none of them large enough to trigger alarm. All of them consistent enough to hollow out her account from the inside. By month 8, Maya's BNPL commitments had quietly consumed $4,200 of future income that she had already mentally allocated to other things. And she had no single screen, no single number, no single moment where any of that became visible. Until the 15th of the month when her account showed $23. Now let me show you exactly why this happens. Because it is not an accident. And it is not a failure of discipline. Here is what is actually happening inside your brain when you use buy now, pay later. When you see a $200 price tag, your brain reacts. You pause. You evaluate the full cost against your current situation. You might even decide not to buy it. But when that same $200 becomes 4 payments of $50, something measurable changes in how your brain processes the decision. Behavioral economists call this payment decoupling. It is the psychological separation between the moment you make a purchase and the moment you feel its financial impact. And when those 2 moments are separated, spending increases, consistently, measurably, across every demographic that researchers have studied. A study published in the Journal of Marketing Research found that payment decoupling does not just make purchases feel more affordable. It actually reduces the psychological pain of spending, which means people not only buy more things, they feel better about buying them. The BNPL industry understands this. It is not incidental to the product. It is the product. Klarna, Afterpay, and every major pay-later platform are not offering you a payment tool. They are offering you a psychological reframing of cost. And that reframing has one consistent effect across millions of users. It makes spending feel cheaper than it actually is. Not because the price has changed, because the moment of financial consequence has been moved far enough into the future that your brain stops registering it as a real cost today. Maya did not overspend because she was bad with money. She overspent because a system she trusted was specifically designed to make her feel like she was not overspending at all. And that system goes deeper than one purchase. Buy now, pay later is not designed for one purchase. It is designed for repeated behavior. Every time a transaction feels manageable, the likelihood of using the same system again increases. The apps know this. Their entire business model depends on it. Klarna reported over 150 million active users globally in 2023. Afterpay processes billions in transactions annually. These are not niche products for people with poor credit. These are mainstream financial tools used by millions of people who consider themselves financially responsible. And here is the structural problem that none of their marketing acknowledges. When you have multiple BNPL plans running simultaneously across different apps, there is no single dashboard, no consolidated balance, no total that any one platform is required to show you. You have a payment on Tuesday, another on Thursday, 2 more next week, each one small, each one from a different app, each one feeling entirely separate from the others. Your brain is not designed to mentally consolidate fragmented payment schedules across 6 different platforms and arrive at an accurate total. Nobody's brain is. The absence of a single number is not an oversight. It is the feature that keeps the system working. And when multiple small payments begin stacking on top of each other, the effect on your monthly cash flow is something most people do not see coming until it is already too late. Let me show you exactly what this looked like in Maya's account. By month 8, she had 6 active BNPL plans running simultaneously. A clothing plan at $37 per payment. A tech accessories plan at $52 per payment. A skincare plan at $28 per payment. A homewares plan at $44 per payment. A gift purchase plan at $25 per payment. And the original boot purchase still running at $45 per payment. Each one individually is entirely manageable. Combined, $231 leaving her account every 2 weeks. $462 every month. Before rent, before groceries, before a single discretionary decision. And because those payments left on different dates, spread across Tuesdays, Thursdays, and the occasional Monday, Maya never saw $462 leave at once. She saw $37 here and $52 there and $28 somewhere else. Her brain processed each one individually. Her bank account experienced all of them together. This is what researchers call the accumulation effect. Individual payments that feel harmless in isolation create cumulative commitments that are anything but. And the most dangerous moment is not when the payments start. It is when life happens and those payments are still going out regardless. Here is the part of the buy now, pay later conversation that almost nobody has. The real cost of BNPL is not interest. Most platforms charge no interest on standard plans. It is not late fees, though those exist. It is not even the total balance you accumulate. The real cost is what it does to your cash flow. Your money becomes pre-spent before you receive it. Every BNPL commitment you make today is a claim against your future income. A future paycheck that has already been partially allocated before it arrives. And when life happens, a car repair, a medical bill, a boiler breaking down, an unexpected expense of any kind, you discover that your income is not actually available. It has already been committed to payments you made weeks or months ago. A 2023 Consumer Financial Protection Bureau report found that BNPL users were significantly more likely to be overdrawn on their bank accounts, carry credit card balances, and use payday loans than non-BNPL users, even controlling for income level. This is not a coincidence. This is cash flow compression. And it is the real trap. Which brings us to one question. Here is a simple question, and I want you to answer it honestly before we move on. If you added up every buy now, pay later balance you currently have open, across every app, every platform, every purchase still running, what would that number be? Most people do not know. And most people, if they found out, would feel uncomfortable with the answer. That discomfort is information. And information is where control begins. Here are 4 steps. You can start the first one tonight. Step 1. Get the real number. Open every buy now, pay later app you currently use. Every single one. Klarna, Afterpay, Zip, Laybuy, Payday, Sezzle, whatever is on your phone. Find your outstanding balance on each one. Write them down on a single piece of paper. Add them together. One number. No guessing. No rounding. No averages. The actual total. This step alone changes your relationship with the debt because for the first time your brain gets to process the full cost rather than the fragmented version the apps were showing it. Step 2. Stop immediately. No new BNPL plans. No new purchases. Not temporarily, not just for this week. Until your current total is fully cleared, every new plan you open is moving in the wrong direction. Adding more while trying to reduce an existing balance is like bailing out a boat while the tap is still running. Step 3. Clear smallest first. Look at your list. Find the smallest outstanding balance. Direct any extra money this month toward closing that one completely. When it is closed, move to the next smallest. This is the debt snowball method, and it works because each closure removes a payment from your monthly cash flow, giving you progressively more room to clear the next one. Each plan you close is breathing room you are giving yourself back. Step 4. Build the buffer that replaces the temptation. The reason most people reach for buy now, pay later is not greed. It is the absence of a buffer. When there is no small amount of accessible cash available for unexpected or semi-planned purchases, BNPL fills that gap. Once your plans are cleared, redirect what those payments were costing you every month into a separate savings account. Call it your purchases buffer. Even $50 a month builds to $600 in a year. Money that is yours with no payment schedule attached. When you have a buffer, the temptation to split a payment disappears. Because you already have the money. Maya sat down one Sunday evening with a notebook and every Pay Later app she had ever downloaded. Took her 40 minutes. The total was $4,200. She did not panic. She did not feel ashamed. She felt, for the first time in 8 months, like she understood what had actually happened. It took her 4 months to clear every plan. She started with the smallest, $112 remaining on the skincare set. Then the next. Then the next. By the time the last plan closed, her monthly cash flow had increased by $462. Not because she earned more, because she stopped pre-spending money she had not yet received. The trap was not her spending. It was the system she was spending inside. And once she saw the system clearly, she stopped being controlled by it. If Maya's story put a number or a decision into sharper focus for you, that is exactly what this channel is built to do. Subscribe to Zero to Zenith Finance for a new financial wake-up story every week. Stories built for people who want to understand money clearly and build something real. And if you want to understand how everyday spending decisions are quietly building or destroying your financial future, that video is right here. Thanks for watching. I'll see you in the next one.